Good morning, everyone. This is daily trading analysis with the weekly recap for the week of the 22nd, the last complete week of the month. Next week, we are going to change in the middle of the week to May. So this week is basically positioning for next month. And this week has been quite volatile. It was way better than the last week, in which we just went red after red after red day. This week has been plenty of economic data. We got a lot of volatility due to that, and also a lot of tech earnings that we are going to review. So we are going to go straight into the economic data from the fundamentals, reviewing the earnings from the big tech companies that are starting to report, and also take a look to the open interest in equities, the interest rate probabilities, technical analysis, individual tech stocks, dollar, yields, bonds, breadth. This weekly recap, remember that is super complete. It's quite a big and extended video. So stay with me if you want to be aware of what happened this week in the markets. Let's go straight into the economic data and review what Monday. Monday was only Chicago Fed national activity. It's basically flat on the 0.15. We were expecting the same as before, so national activity index a little bit higher. But look at this at these two bill auctions. These two bill auctions are still remaining quite high at 5.25 the 3 months and the 5.16 on the 6 months bill auction. It's basically the same kind of interest, and this means that yields are still providing a lot of profits to those that are staying with them. And this higher for longer goes through everything, not only for the interest rates for the funds rates, but also for mortgages, for bill auctions, for treasuries. I mean, be careful because this higher for longer narrative is still with us. On Tuesday, we started to see more data from the building permits, month over month, minus 3.7, telling us and the Fed that the housing market and the building permits are cooling down a bit. That's really good for the markets. But the big news on Tuesday was the S&P Global PMI and the services section. These services is an estimate, it's a flash from April, an advanced data. And look at this, all three PMIs came barely at 50, coming from 52s and 51s. And market was expecting really staying at 52 or even increasing. But the services one, the sticky part, was at 50.9. And this coupled with the fact that new home sales are spiking a bit, and manufacturing index also it's in the negative, -7, -10. On the services index, -13. Was a really good day at Tuesday in which we rally and we were starting the week, continuing the week with a bullish sentiment. On Wednesday, things started to go a little bit south because Wednesday on the MBA mortgage rates, we are still seeing 7.24 coming up from the 7.13 on the mortgage rate on the 30-year, and obviously minus 2.7 on the mortgage applications. Refinance are still going higher, quite high, about 450, because people are trying to get rid of bad mortgages. On the durable goods front, 2.6, 0.2 excluding transporters, non-defense good orders 0.2, excluding defense 2.3. All this is basically saying that durable goods are still going higher, still going hot. And look at the increase from the previous one. This is basically pushing prices higher because orders, weight orders, consumer spending, this is all inflationary pressure. On Thursday, we got the advanced GDP growth, and this was quite a hit for the market because the growth rate came 1.6, coming down from a 3.4. It's quite a hit. The consensus was obviously decreasing a little bit, but a downtick to 2.5. And look at the price index, 3.1. Wow, from 1.7, that took a hit. Core PCE prices quarter over quarter, 3.7, coming from the 2%. And we were expecting obviously an increase, but even beyond that, it was worse than expected. And PCE prices also coming up 3.4 for 1.8. That really caused the market to really sell off. And at the end of the day, on Thursday, we got a rally due to Alphabet and Microsoft reporting earnings. And we went into Friday with that sentiment of the tech earnings being boosted. But take a note of these fundamentals throughout all this week, because the picture did not happen. The only that happened this week is that tech earnings are more or less pretty decent. Some of them are really good, but the fundamental beyond that, it's still the same. Inflationary pressure, data coming up with still shows a hot economy. Prices are not going down, spending is still going down. And look at this 50-year mortgage rate and 30-year mortgage rate, still pushing higher. And the 7-year note auction, 4.7 from 4.18. So yields are still going higher. And Friday took the final nail in the coffin. Core PCE price index month over month, same as before, 0.3. As expected, but 0.3. It's not coming down. On the month over month general, 0.3, 0.3. So it's not going down. It's not good news. It's not bad news because it's not increasing, but there's no progress. And year over year, we are staying at 2.7, coming up from the 2.5. And in the core PCE, we are at 2.8, staying from the previous one. We were expecting in both these year over year readings a decrease, but it didn't happen. And apart from that, look at this income and spending. This is quite interesting because the income is 0.5, a little bit from the 0.3. This is inflationary. And look at the spending, 0.8, higher than the income. So the consumer is getting more and more frustrated and getting more pressure, feeling more pressure from the prices. We were expecting in the spending a decrease, because that would be easing for the consumer spending. And this is coupled with the fact that all these consumer sentiment final for April, look at this, 77 coming down from 79, expectations coming down also. And look at this, the 5-year inflation expectations is 3% from the 2.8, and the current conditions final, the inflation expectations final, 3.2 coming from 2.9. If we see the trend on these inflation expectations, we are, since November, we were quite good on the consumer expectations, but we just spiked to 3%. And on the inflation expectations, general 3.2 is pretty bad. Obviously, we are way better than we were in the end of 2023 at 4.5, but we were at 3, 2.9, 3, 2.9. We were trying to go below 3, and now a spike to 3.2. It's really bad in my eyes. So let's recap the sentiment of the week, because all this data started pretty decent on Tuesday with the global services coming down, but day after day, we were receiving the same kind of data with the same kind of sentiment, outlook, and expectations. Inflation is here to stay. Inflation is sticky. Consumer sentiment is just getting stressed out. Personal spending is keeping up. PCE prices are going up, and that's one of the key measures that Feds are seeing. And obviously, GDP took a big hit. So why the market stayed pretty much green and we were so bullish some days? This is because of earnings. Meta plunged 16% on weak revenue, but Reality Lab posts 3.85 million loss. So Meta took a big hit. I think people is just seeing Mark Zuckerberg putting more and more money in this sector, in this section of the business that it's not getting any profit in 5 years. So Meta just took a big hit because they are investing in what they see as the big hit in the upcoming years. But this is not getting profits. Microsoft, on the other hand, loves growth, back, accelerating AI push, and this was pretty good for Microsoft. Good earnings, good growth, and this is what the market expects. And also Alphabet jumped 14%, and it also announced the first ever dividends, and it's looking good for Google because basically they have YouTube advertising going higher, Google Cloud going higher, and acquisition cost going higher. So what does this mean in terms of the market pricing? We obviously went up. Tech, Google reached the 2 trillion market cap this week due to this push, and the tech sector pushed the market up. But remember what I told you about the fundamentals. I think we don't have to forget about the underlying pressure of the inflation, of prices, and the outlook from the consumer, because once the tech earnings pass, we will have to see how the economy holds and how the inflation progresses, because right now everyone is just blindly following the jump in the tech heavy stocks that are pushing on earnings. But tech is not the entire market. We have to check what happened with Breath, that we are going to check also later. And the sentiment on the interest rates is still there. On September, we are going to basically 50-50 to cut. And it's only going to be one cut this year until March 2025. So this is not looking good for the consumer. This is not looking good for economy. This is higher for longer. We were expecting even 6 cut last year, down to 4, down to 3, down to 2, now down to 1. So the underlying pressure of deflation is not going away. But at the same time, market it's still rushing higher. Before moving into the charts, I would like to provide you a little bit of insight on the open interest on Friday, because on Friday we rallied again. And this is the second time that we rally. Also on Thursday we got a big push, and on Friday we got a big push, both fueled by the tech earnings. But what happened with the open interest is really interesting, because we got minus 28,000 on an up move. That means short squeeze. This is on the S&P 500 futures. On the Nasdaq, we also see the same. 6,000 is quite a lot on an up move. So short squeeze. This is not money inflows coming in the market interested on seeing higher pricing. This is just shorts that were short down the barrel, shorts at the bottom that are now covering. Because of earnings, they were basically betting of bad earnings and they got squeezed. So I'm not confident seeing this open interest being in the negative on upper moves. I would like to see bigger interest in up moves, because that gives me confidence of big money coming in, investors coming in. So with this picture, now let's go into the charts and let's see what happens with the price action. This is the weekly chart on the NQ after last week 5.49% decrease. So this candle was pretty bad. I don't remember one such candle of 5.50 in the red since maybe September. This one here was 5.36%, but this was a really bad week. Now we are up 3.87, boosted by tech earnings. And as you can see, I have on the daily, I had the retracement for higher to longer to down here, and we went through the golden pocket and we are now pushing higher. But look at how we are pushing. Monday, Tuesday, big day, Wednesday, bad day, meta, Thursday, and Friday. Look at this chop. This chop, coupled with the fact that open interest is negative on a bounce, that I don't like hitting that. And also on the weekly, we are still if we check last week's performance, we are in a retracement. So we are not out of the woods yet from a technical standpoint. I'm not trusting this bounce unless I see a little bit of continuation and better price action. Look at these candles. This is not smooth price action. So what can we do with this? Obviously, the daily got destroyed. This daily does not, the bullish fair value gap is not anymore there. We cannot trust that, so we balance that and we are bouncing. We are below both 45 and the 20 moving average on the daily, so we are still looking pretty bearish. Let's remove that and let's see. I would like to see this retracement for this week, because basically we are at the 50% retracement. This is a normal bounce from a big sell-off week. And on Friday, let's just see what happens on Thursday. This was the push on Thursday on the big tech earnings. Remember, short squeeze, negative open interest. And on Friday, we also got the same. Price action overnight, just holding there, and then a push higher with negative interest. That means short squeeze. So shorts were squeezed, and I think they were positioning pretty bad here. They were shorting at the bottom, and on the higher time frames, on the 1 hour and the 4 hour, we are still looking pretty bearish. We have some structure here that I'm for sure going to see. So this 4 hour fair value gap is going to provide me a little bit of support if things get better. But look at this 4 hour inverse. We are in the middle of a big range in which sellers, I think, need to recommit if they see this market going lower. So basically we are here. I'm watching this zone at the fifth retracement. We are basically at this structure. So this zone of support, of resistance, is going to be quite key for next week. But I'm not confident. Let me tell you, let me be honest. I'm not confident in this move because the fundamentals didn't change, are getting worse, and this is only a push on tech earnings. But tech is not the entire market. We need to see other markets to see if they are also bouncing. We are going to see that in the charts later on. Let's review the individual tech stocks to see how did they perform throughout the week. So basically, Apple bounced from, let me just see for regular. Apple just bounced from 165 to 170. It's not a big bounce. We are still doing lower highs, lower lows. So I mean, we are not out of the woods. Apple is being beaten this year quite a lot, because basically if we check the price since the start of the year, we started there and we are down 12%. We were down 15%. So Apple is not looking good. Microsoft, big gap on earnings. So let me just adjust the gap. Big gap on earnings, but we are still below both the 20 and the 45. So even though Microsoft, I think, has a good outlook, there might be shorts up here willing to commit. So Tesla, big gap also again. Tesla is super oversold. Look at this. This is just the start of the year. From here to here, we were 43% down. We are right now 31% down on Tesla. Not looking good. Amazon, big gap, big bounce. Even though consumer sentiment is not looking good, Amazon, it's in the middle of the two big daily moving averages. I think this level of 180, it's pretty important. So if we see continuation, we might see some push through all-time highs. Amazon could be the next 2 trillion market cap stock after Google. Let's see what happens, but we need a pretty strong consumer confidence. Google, I mean, this is unbelievable. A huge gap, it's just, I mean, this is brutal. Google destroyed everyone's expectations, and it was basically 10% or even higher. We were at some point 11%. We closed 9.97 on Friday with a huge gap that we have to now adjust all-time highs, and obviously this previous gap. The market cap on Google, it's 2.15 trillion. So pretty interesting. Google is just skyrocketing. Google is unbelievably strong. Nvidia also, it's entering into, I was waiting for a little bit more of pullback to maybe fill this gap and then bounce on the 50% retracement, but we are not there yet. Let's extend this a little bit. So we are in the middle of this range that I think in the upper hand side, Nvidia looks way better than it looked after this candle last week, in which it lost 10%. Friday it was 6%. So I think a lot of money being poured on Google and Nvidia. That's why the Nasdaq pushed a little bit this week, because in 2 days Nvidia just pushed 11%. So remember that investors and big hedge funds are always invested in the market. They are just moving money from one asset to another. And looks like Nvidia and Google are quite receiving a lot of inflows on money. And Meta, big gap down. I mean, it was pretty bad. Nvidia looks, Meta looks pretty bad. It was also a big gap up and now big gap down. I mean, Meta is quite volatile. We are below the 2 moving averages, and let me tell you, this is just looking pretty bearish. Google and Nvidia just pushed this market higher with a little bit of Microsoft, but overall, I don't see the Nasdaq as super strong. The same way, yes, last week, weekly recap, I told you, I think this market is going to bounce. From a technical point of view, this market were due to bounce. We got structure here that we basically hit and bounce a bit, but that doesn't mean we are out of the woods. We might see this happening. And I'm not super bullish coming up to the next week, because things like dollar are still pushing. Dollar on Friday pushed a lot. And we are just, look at this. I think this is just accumulation for another leg up. I can see dollar on 107 next week, because we are approaching this. And also look at yields. The 2-year yield, it's pressuring a lot of here. It's at 5% exactly. The 10-year, it's at 467, and it's going higher. I mean, we are in an environment in which dollar and yields are still pushing higher. The interest rates futures on September crept higher. Look at this. This is the September. This is September interest rate futures at 5.20. Obviously, no interest rate cut. No interest rate cuts. And Russell it bounced also, but apart from dollar yields, we have crude oil also creeping higher. We have gold holding up, metals continuing pushing higher. So this is something that we have to take into account. We have to see the overall picture. Let's see how the breadth reacted to this week, because basically this is the RSP, the equal weighted ETF. We bounce from a technical point, from a technical level. Previous resistance is now support. Golden pocket on the 50 retracement from the all-time highs. And we are right here. Right here. What happened with the percentage of stocks on the 200? This is the 200. We are at 54. We went down We pushed a little bit, but now we are again pointing towards down. And we have a lot of space down here. This is the 200. This is the percentage of stocks above the 50 daily moving average. Notice how I have this level down here, which is basically the what I would see as investors having a good amount of risk reward ratio below 60. So basically, let me just adjust it to regular. Sorry about this. So below 13, this is just a discount price. We are at 39, and look at the way we've been getting breath. So at the same time that overall market was pushing higher, on the 50, we were pushing lower. And on the 20, which is this one, we are also moving lower. Now we bouncing a bit because we are seeing a little bit of momentum from a bounce from a discount point of view of 11. But this is the 20. The 20 is quite volatile right now. But the overall trend, the 200 and the 200 and the 50, they are negative. I can see this divergence happening right now. So breadth is not improving the same way the sentiment for the tech stocks is increasing. And I think we have to take that into account to manage expectations. We have to manage our expectations in terms of, we have to manage our expectations in terms of breadth and in terms of fundamentals, because I can see this market just choppy, creeping higher, and then a big move down. I'm not trusting this because I can see on a fundamental point of view, after the huge sell-off last week, big money is well positioned to continue lower. We had 2 days of short squeeze this week, but tech earnings are not the entire market. Google and Nvidia are massively being poured money on, but the Nasdaq is not looking super strong. The way we bounced is not looking strong. And I had this retracement here. So from a technical standpoint, we are still in the middle of resistance. I would like the market to enter the inverse, bounce a little bit, have this zone as support, and then start creeping higher towards maybe 18,280 or something like that. This zone, it's quite important. We have an order block here, and we have an order block here. And I would like to see this happening. This is super important. This is market structure for me. I would even consider some kind of bounce like this, because this fair value gap is also important for me. So I would be super patient next week. I don't want to be super bullish entering tech earnings again. And next week is going to be also earnings from the tech. So be really careful with what kind of sentiment you enter the week, because from a fundamental standpoint, I think money is still being moved. We are seeing dollar yields and breadth diverging from the Nasdaq a little bit. We were super choppy throughout all this week, and I'm not confident. I'll show you why. These videos are made, I make these videos to really be with me, follow me on this analysis. And if you have other ideas, if you have other analysis, just let me know in the comments. But I'm just being super transparent, super honest. I'm not feeling confident on the Nasdaq until I see some kind of structure being made towards the upside and towards these levels up here around 18,000 to 50 to 80. The first thing that we need to do is reclaim 18,000. 18,000 is quite important. After that, we might see if we build some more structure and we can build more sentiment to the upside. But I'm not super confident. This is one case. And the other case is just reclaiming this zone up here and just rejecting, entering the fair value gap and start losing some kind of momentum. And here I would be super bearish because this is liquidity and this is liquidity. And you might see some continuation to the downside. So there we have the two options still in play. We are, in my opinion, honestly, we are just bouncing. This is a relief bounce from the tech earnings, and sellers are going to recommit next week because there are technical levels that are not yet reclaimed. And from a fundamental standpoint, we are still super bad in terms of inflation and in terms of GDP, in terms of consumer sentiment. We are pretty bad. So be really careful next week. Have patience. Do your due diligence, your own analysis this weekend, and start fresh on Monday without any bias. Without any bias. And I think you would understand how the market develops and how you find better opportunities without any bias entering the week. I'm almost a permeable. I would like to go long for better, but this structure is not enough. I need something more. And that's all from my side. As always, thank you for your time. If you found this video useful, please give it a like, subscribe to the channel. I upload videos like this weekly recap every Saturday for you to sit down, relax, and follow me on the analysis on the entire week and prepare for the next week. These are videos that I put a lot of effort on. So if you find them useful, follow the channel, support my channel because I love doing it. And if you learn something, I'm really happy, only with that. So remember what I said, discipline, patience, risk management is super important. Don't try to chase price action because manipulation is still pretty high. Volatility is still pretty high. And that's all. Do your own analysis, enjoy the weekend, rest, disconnect, try to disconnect, go out, and next week we are going again on Monday in this channel. So see you on Monday. Have a nice weekend. Stay safe, everyone. Stay safe, everyone.